Mark, thank you very much for joining us today. How are things in Thailand?
Everything is fine except the economy is not doing particularly well.
Well,
But
I
the
want to have a
country is one of the most popular tourist destinations and retirement destinations, which is interesting because economists call Thailand a failed state, and yet it is so popular among people. So the definition of failed state may be wrong.
Yes, well, it always comes down to the government and the actions of the government. And I want to have a deep discussion with you on what's happening with various economies throughout the world. And before we do this deep dive on the economy, I want to first ask you about the country of Switzerland, the country where you were born and raised. And I was recently in Switzerland. I flew into Geneva, I flew out of Zurich, and I hit a number of spots in between, and I was blown away by the raw natural beauty of that country. It's just a gorgeous place. But I want to ask you, what's your favorite place in Switzerland, and what do you miss most about living there?
I met once a girl. She was then my girlfriend, but that's a long time ago. And she said, Switzerland is the most beautiful country God created. Unfortunately, he put the Swiss people there.
The French or the
And
Germans?
it is true, it's a beautiful country, but it's not as beautiful as, say, 40 years ago because we had a lot of population growth. I mean, when I went to school there and grew up, the population was less than 6 million, and now we're approaching 10 million. So the country has been populated very densely, and a lot of beautiful spots. They've been sort of uh, encroached upon by industrial and commercial developments. But I agree, it's still one of the better countries in the world among the, let's say, more developed countries. And it functions reasonably well, not as well and as clean as it used to be, but still relatively compared to other countries in Europe, France, Germany, and so forth, it functions reasonably well.
Yes, and one of the things I admire about the country is it has strict immigration laws, and there's also laws against protesting. You're not allowed to protest.
Well, the immigration laws are not strict enough, in my opinion. And from the time I grew up, the country has moved to the left. The socialists have become much more powerful, but still, uh, as I said, relatively speaking, in a good shape.
So let's discuss the markets now. And I'm sure you would agree with me when I say 2024 was one hell of a year for the US markets, especially. The S&P was up 25%, the NASDAQ was up 25%. The US economy is still very strong, the strongest in the world, growing at 2.5 to 3% annualized. What surprised you most about 2024?
Well, I have to correct you about the growth of 2.5%. Uh, we need to make adjustments to the figures that are published by governments. Because if the government says the economy grew at 2 to 3% per annum, okay. But if you adjust economic growth for the true price increases within the system, not the CPI figures that are compiled by government agencies that understate the rate of inflation. So if you adjust this by the true rate of inflation, probably there was no growth, or actually, for most people, negative growth because the price increases exceeded the salary increases. Number two, I mean, I looked the other day at the debt level in America in 1980 because I started to work in 1970 on Wall Street. And as you know, by 1980, 81, government bonds started to rally because during the 70s, interest rates had gone up. And the rally in bonds then created a rally in stocks beginning in August 1982. So we have a major turning point from poorly performing financial assets throughout the 70s to improved financial performance going forward from 1982 onwards with stocks and 81 for bonds. Now, the debt level, federal debt level, was less than $1 trillion in 1980. Now we are 36 trillion. So you understand when you say the economy grew by, say, 3% and government debt grows by 5% or 3%, then the growth that you are saying is not truly real. It's a kind of artificial growth that is due to increased government borrowings. And this increased government borrowings will over time lead to increased interest payments on the government debt. And then the budget cannot anymore be balanced because most of the expenditures become interest payments on the government debt, and there is less money for other things and so forth. So you understand? I think that when people look at GDP, they have to be very careful and analyze what caused growth. Was it just price increases or government debt increases or credit in general, private credit growth and so forth? And in my opinion, there maybe have been nominal growth of 2 to 3%, but in real terms, 70% of US households are worse off than a few years ago. They haven't recovered to the 2018 level or earlier levels.
Yes, you raise a few interesting points there, and I just want to add a little more context. You made mention of the fact that the government debt is $36 trillion. The interest on that debt is over $1 trillion. It's only going to climb as time goes on. And then, so I want to take the other side of this argument, though. If you look at debt as a percentage of GDP, depending on whose research you look at, it's somewhere between 100% to 110%. But if you look at Japan, for example, their level of debt to GDP is over 200%, and yet they're functioning quite well. Why should we be concerned with this debt?
Well, you're saying they're functioning quite well. The currency has weakened very considerably. So the purchasing power of households has been declining. And the Japanese claim they have very little inflation. But I can assure you, I've been going to Japan for the last more than 50 years. And Japan is always an expensive country. Now, there are times when it's relatively cheap, and there are deals, you can have a holiday, skiing holiday in a package, relatively reasonable price. But otherwise, the country, say, if I measure how much it costs you to travel from the airport to the city, then in Tokyo, if you take a taxi, it will set you back almost $200. So, in Singapore, I can go from any place to the airport for, say, 25 US dollar. Hong Kong, a little bit more, maybe $30 US. So I'm just saying, the Japanese in recent times, in other words, in the last, say, 2 years, the population has lost considerable purchasing power because of the weakness in the yen. And most people in Japan get paid in yen, and salaries haven't gone up that much.
And so, once again, you're expressing concern about the U.S. economy. You don't think the U.S. economy is as strong as we're told it is.
This is what I think, that the economy, and I see that myself because I'm an economist and a social observer. But two, I'm a wealthy investor, okay? So as a wealthy investor, I pray that the Fed will continue to print money and that as a result of this money printing, asset prices stay high or move higher. In other words, I, as an asset holder, I don't want assets to depreciate. But as a social observer, I can tell you that the majority in a population, whether it's in Asia or in the US or Europe, the majority is not progressing at all because whatever wage gains they have, and these wage gains are not huge, they lose out on increased cost of living expenditures. And the Fed relies on the Bureau of Labor Statistics, and the Bureau of Labor Statistics publishes lies. According to the BLS, the Bureau of Labor Statistics, healthcare costs have been down over the last 3 years. I don't know any insurance company in the whole world that has lowered its premiums over the last 3 years, which is an indication of healthcare costs. Number two, most prices of pharmaceutical products are not going down but up. It may be true that some drugs that come off patents then decline in price, but by and large, send your children once or your parents to hospital, you will wake up how much a hospital costs. That I can assure you.
So
So
let's
I question the statistics that the government publishes, as I question everything else governments do.
100%. I'm the same way. And it's funny you talk about inflation or the CPI number. The CPI number has undergone so many changes since the early 1980s. And at one point, they would actually include the cost of interest in the CPI. And then it got so far out of control, they said, we got to remove this because it's making us look bad. So, yeah, to your point, there's total manipulation going on with these government numbers.
Correct. Because the government benefits from a low CPI number in terms of social security payments that are adjusted according to the CPI. And two, if they can keep interest rates relatively low. By relatively low, I mean that, say, if you look at the inflation today and you look at the 10-year Treasury bond yield, the Treasury bond yield 10 years is less than 5%, say 4.5%. But in my view, for the typical household, the cost of living are going up by more than 5% per annum.
100%. Yeah, I'm sure the real number is probably like 10%. So let's have a little deeper discussion on inflation because the moves we saw in 2024, I'm talking about the US equity markets, it was all predicated on the Fed cutting interest rates because the Fed believes they have inflation under control. And I saw an interview recently with Stanley Druckenmiller, and he said the biggest risk in his mind, the biggest threat to 2025 would be a reacceleration of inflation. Paul Tudor Jones, he also said similar comments. He said all roads lead to inflation in 2025. And I think their concerns have to do with uh, uh, tax cuts and also higher tariffs or the imposition of tariffs, and these are going to have an impact on inflation. What are your thoughts on inflation, and do you think it will reaccelerate in 2025?
Well, this is a very good question, and we don't know the answer because, on the one hand, I expect a recession. I think we are already in recession now, but through government statistics, the recession is essentially kept off the public's attention. In other words, the standards of living of most people are going down, but the government shows, as you say, 2.8% GDP growth or whatnot. But I feel that one day the recessionary trend will become more obvious. And at that time, I suppose that interest rates on the 10-year treasuries and on the 30s will rally somewhat. In other words, in a recessionary environment, I would expect inflation to decelerate. But then we have monetary policy and fiscal policy that are highly inflationary, highly, especially fiscal policies. And so it is possible that even if the US went into recession, at the same time, we would have accelerating inflation. That is a possibility. And I wouldn't dismiss that possibility entirely. So exactly how interest rates will move, I don't know, based on inflation figures. But my suspicion is everybody and his brother-in-law are selling bonds. In other words, they invest in stocks, but they avoid bonds. And I think there's a case to be made that, say, for 3 months or 6 months, bonds could outperform stocks. Also, Paul Tudor Jones, in his interview, he said it's sort of, I mean, he didn't spell it out very clearly, but the essence was avoid being long bonds, be short bonds. And the street, the Wall Street, is heavily short bonds, heavily. But on the other hand, the commercials, who are usually well informed, they're long bonds. And I would rather bet with the commercials, in other words, with the people who are very close to the market, the hedgers.
You made mention of the fact that the US 10-year is around 4.5%, give or take. And we've seen a big move, especially since September. I think it's gone from 360 up to the current level. And I guess the anticipation is once again it's coming back to inflation, and that's why we're starting to see this 10-year move up the way it is. But also on the back of that, we're seeing a very strong US dollar, and just against the Canadian dollar. I'm based in Toronto, but the Canadian dollar was down 10% in 2024. Do you think the US dollar will continue to be strong in 2025?
I want to address two issues that you mentioned. What is interesting is that over the last 6 months, the Fed cut short-term rates by 100 basis points. But bond yields have gone up 100 basis points. So it would indicate to me that whereas the Fed may control short-term rates, they've sort of lost control of long-term rates. I'm saying sort of, because obviously if they cut short-term rates to zero, I suppose that the bond market would rally somewhat. Or they could introduce negative interest rates on short-term deposits. But to the anticipation of the dollar, I mean, I shouldn't say this, but I think the dollar is grossly overpriced, grossly. But you understand, in a money printing environment, it's very difficult to have a view on fundamentals, because what you can have is, I wrote about this recently. The housing market, basically, in some areas in America, is back to the level in 2018, 2019. But the housing ETF is up very substantially. So we're dealing with, in a money printing environment, with essentially a money economy, and at the same time, the real economy, that what is going on between people when they transact, they buy and sell the house, or they rent something, or they sell something at Home Depot, or buy something at Home Depot. That is the real economy. But the artificial economy is driven largely from the money printing and the fiscal deficits. And these are two different things. So you have a mispricing and a misallocation of resources. But as I said, I think the economy is far weaker than what the government is publishing.
And what exactly are you looking at to give you that sense?
Well, there are many indicators. We can look at industrial production as an example, or we can look at the retail sales at department stores, and we can look at the announcements of, say, retail chains that cater to not very affluent people, say Dollar General and Dollar Tree, and to some extent Walmart. If they tell you that the people are struggling even for daily necessities, we have to sort of believe that. They have no incentive to downplay their business. But if they themselves admit that people are struggling with maintaining their purchases of goods, and that some are cutting back, not because they want to slim down, but because they can't afford to buy these goods and provide them with services.
So let's talk about valuations now. And as I mentioned earlier, the S&P and the NASDAQ were both up 25%, give or take, in 2024. And you have lived through many cycles, and I want to get your thoughts on this cycle and the level of speculation that we're seeing. It just blows me away by some of the moves that we've seen in various asset classes. And you touched on this recently in one of your newsletters. It was titled The Consequences of Asymmetrical Monetary Policies. I would encourage our viewers to check it out on your Twitter page. But Nvidia, for example, the poster child of this whole stock market bubble, it was up 172% in 2024. Market cap is well over $3 trillion now. Tesla was up 80% in the last 2 months of the year. They just came out with some negative news here in the last few days, but their sales or deliveries were below expectations. So the stock has gotten drop kicked here in the last little bit. And then when you look at some of the stuff going on in cryptocurrencies, once again, Bitcoin was up 100%, but there's a lot of other names out there. I don't know if you've heard of this coin called Fart Coin. It's a meme coin. Its market cap is $1.5 billion. But when you look at some of the things going on right now, does this remind you of the 2000 tech bubble?
Every bubble has a lot of similarities, but also dissimilarities. But to some extent, the current bubble is unprecedented because it covers so many different sectors. I mean, it's not just in 1980, we had an energy bubble. So energy stocks had gone through the roof, and also mining stocks, but it was a very small sector. And it occurred at the time, the 1980 energy boom, when the stock market capitalization of the US as a percentage of the economy was around 30%. We're now at over 150, 160%. So the bubble occurred in an environment of low asset prices. And now the bubble in technology and in the Magnificent Seven and in the FANG stocks and so forth occurs in an environment of relatively high valuations. Plus, we have, as you pointed out, all these cryptocurrencies. I mean, you may have a view, but I don't know exactly whether we should add the market cap of crypto to the money supply figures. You understand? Certainly, out of hot air, you've created a new sort of a currency. And I'm not sure exactly how to capture that in the general statistics, but uh, everything seems to be in a bubble. No, it's not just the US stocks. Now, I can see that some stocks are not in a bubble, like Hong Kong property stocks. They've been going down for the last 5 years, or some stocks in the emerging markets, they've been going down for a long time. So they're not in a bubble. By definition, a bubble creates undervaluation in other sectors. But the undervaluation in other sectors today is not as pronounced as it was in year 2000 and in year 1980, not as extreme. So it is possible that some sectors in the US will badly deflate. I mean, you mentioned NVIDIA and Tesla. Tesla and NVIDIA are the most widely held stocks in individual portfolios in America. Now, I'm not arguing for or against Tesla and for against NVIDIA. But one thing that strikes me is there is a lot of uncertainty about the future earnings. And two, the valuations are sky high. This nobody can deny. High valuations and uncertainty about the real value in future, in my opinion, is not a recipe for guaranteed success in the ownership of these assets. Probably quite the opposite.
Another interesting point about Nvidia is I read something recently. Its market cap is approximately 12% of the GDP of the US. And the author of this research note that I read was comparing it to Cisco back in the year 2000, because Cisco was like the bellwether for that bubble. And
Correct.
at its peak, it represented 6% of the GDP of the US. So they're saying this move that we've seen in NVIDIA is that much more. And when you look at these
Yeah,
numbers,
yeah, sure.
think that
I
market
mean,
cap of
the Magnificent Seven, as a percentage of the economy, the market cap is the highest ever.
So does this concern you, and how do you see things unfolding this year?
Well, I want to explain what concerns me the most, not as a worry, but as an observation and as a strategic tool. The market in 1973, the US stock market peaked out among very few stocks that still went up. We call them the Nifty 50. These were, say, 50 companies where analysts would say they keep on growing, and so they will keep on going up, these stocks. Now, nothing of that sort happened. The Nifty 50 declined in the subsequent 2 years between 74, the January, and December 74, they decline on average by, say, 70%. Okay? And that dragged the entire market down. Very few stocks went up during that time, with the exception of some gold shares, because the price of gold had been in 70 around at $35 an ounce. And in 75, they increased it, but the price went up much more. And so it had gone up to over $200 an ounce. And but the majority of stocks didn't go up. And the same happened in 1980 after the energy stock boom crashed. Most stocks went down. Very few stocks went up immediately, but first they went down. But in Japan, when Japan had a market cap of more than 50% of world stock market cap in 1989, 1990, my view was when the Japanese stock market would go down, it would drag down everything else. But I was wrong. The Japanese market went down and other markets took off. And this is my dilemma today. I think the US market will go down and is not a little overvalued, but massively overvalued because the dollar is also overvalued. But the big question is, can emerging markets, can Europe go up when the US stock market, driven by the Magnificent Seven and the New York Bank stocks, when they go down? Can the other markets go up? I think they can, but it's not sure. If I was convinced that other stock markets, that the money would flow out of the Magnificent Seven, Nvidia, Tesla, and so forth, into other markets, I would be more heavily invested in equities in emerging markets and in Europe. But I have my reservations about this. It could be that we have a general asset deflation where all prices of goods and services decline for a while.
And let's get a sense of what kind of move you might anticipate. So, if we once again look at the tech bubble of 2000, in the ensuing 2 years after the markets peaked, the S&P lost 50% of its value. The Nasdaq lost 78%. Do you see the same sort of moves in the S&P and the Nasdaq this time? If we have this
Yes,
deflationary.
possibly. Yes, yes, possibly. But equally, it's possible that the Fed must know that if asset prices are like in 1980, uh, as an indication, the stock market capitalization in 1980 was just 30% of GDP. So at that ratio, if stocks go down, the impact on GDP is very small. But if stocks are 150, 160% of GDP and they go down, my suspicion is that the impact on the economy will be much greater. I think the growth that you are referring to, and which I'm questioning over the last few years, was largely driven by asset inflation. You understand, somebody owns a house, then it doubles in value, he sells it, he can buy a car. And you will say, well, it lowers his standard of living by going and living in another area and so forth. To that, I say, yes, but a lot of retirees, they lower their standards of living anyway. They are retired. They don't need to spend so much money. In general, I think I spend less money today than when I was 40, 50 years old because I don't buy anything. I have everything already. Well, not everything. I bought 2 new motorcycles recently. 1000cc racing bikes. But I didn't need to buy them. I bought them just out of partly necessity because we had floods and 2 of my motorcycles went into coma. So it takes maybe 3 months to repair them. And during that time, I wanted to have uh, my motorcycles because to ride motorcycles is a daily exercise. You have to do it frequently, otherwise the danger increases.
So you just expressed concern about the Mag 7 and you compared it to the Nifty 50 back in the 1970s. So you're concerned about the valuations. I want to pick your brain about some of other possible concerns and how things might unfold in 2025. We still have hostilities going on in the Middle East. There's still war in Ukraine. We have a
Horrible,
we
horrible.
Yes, we have a slowdown in China. It's the world's second largest economy, representing 20% of global GDP. The European economy, economically speaking, is a disaster. Germany's in a recession and France is probably close behind. and we have a new administration coming in the next couple of weeks. There's a lot of uncertainty there in terms of what policies they're going to impose or put forth and the impact it might have. We might have trade wars. But when you look at all these geopolitical and economic events, what concerns you the most?
I mean, I have to say that for me, humanity has advanced in science and technology and kind of knowledge or information, but it hasn't learned anything. I mean, the war in the Middle East is a complete disaster. It's horrible in every respect. And in my view, there is a chance that this war will expand. I mean, some people think we are in World War III already. I don't think so. And up to now, leaders have been reluctant to use nuclear weapons because they know if one uses it, the other one will do the same. And then it's a horrible destruction. But in general, I don't think that the war would have a dramatic impact on the valuation of equities because you could have a war and the government prints money, and so stocks would stay at about the same level. Yes, I mean, the concern is that this Middle Eastern problem is not going to go away, but escalate. And I mean, I have friends, they're 100% sure that we're heading into World War III, and these are not uh, friends who are ill informed. They're actually very well informed. And they think Israel and the US jointly will attack Iran relatively shortly. And then the question comes up what the reaction of the world will be to an attack by Israel and the US on Iran. Will the Chinese and Russians just stand by? Or because Iran is a member of BRICS, so will they help them and get involved? Who knows?
Yes, there are a lot of big concerns out there, that is for sure. So I just want to wrap up and summarize a lot of the points you made. You think the U.S. economy is in a recession, or if it's not in a recession, it's approaching a recession. You think the market, the equity markets, are at risk for a big pullback this year.
Yes,
And
because of the overvaluation.
right. And so what are you suggesting to investors? How should they be positioning themselves in this uncertain environment?
Look, as I explained, in a normal environment, I would say deposits, although not a high return and probably a negative return in real terms, inflation adjusted returns. But it's maybe better to lose 1, 2% inflation adjusted than to lose 20%. But the problem that I see with deposits is that in a financial crisis, the banks may be under pressure and deposits may not be worth very much. We've experienced that repeatedly in history. So you may be better off in some stocks. They may decline 50%, but you still have the company. Now, people have been talking about the re-ratings for years. In my view, we could have a re-rating on the downside. In other words, today a stock sells at 20 times earnings. Maybe in future it will only sell at 5 times earnings. Could be.
And
I
you,
think stocks will not have a high return, but I think gold and other precious metals are not cheap as they were saying in 1999 when gold was at $253. But compared to the monetary expansion that we had in the world, to the increase in wealth, to the increase in assets under management of the fund management industry. You look at fund managers, most of them have not even 1% of their assets in gold, not even 1%. And I'm suggesting people should have 25% in gold or more. And then, as I said, at the moment, the mood about bonds is everybody's negative. But in a recession, bonds could rally somewhat, maybe not as much as in other recessionary times, but they could rally because A, they are oversold, the short position is very high, and secondly, because the recession could remove temporary inflationary pressures.
Mark, as we wrap
And
up,
then I would say real estate, the real estate market in some areas is very expensive in the US, but there are villages in Europe which are very cheap.
well, that was a great discussion, Mark. And as we wrap up, you are the editor and the publisher of the Gloom, Boom, and Doom report. If somebody would like to follow you online or read more about your services, where can they go?
I'm not sure they should read it, but they can go to gloomboomdoom.com. I repeat, gloom, boom, doom, all in one word.com.
And we will put a link in the show notes below. And we can also follow you on Twitter or X.
Thank you very much.
Mark, I want to thank you for making the time, and I wish you and your family a very healthy and prosperous 2025.
Well, I wish all the readers a gratifying year in 2025. But I need to add a remark. If your happiness depends on rising asset prices in 2025, I think these people will be disappointed. I would prepare for asset prices not to go up. If they happen to go up, then you're going to be very happy. But I would prepare for asset prices to actually experience a setback and possibly a severe setback.
Well, once again, Mark, great comments, and thank you.
I thank you and all the best. Take care.